today I want to talk about how the end is near. I want to quickly touch on what happened today in the wider markets and show you what that looks like, but then explain how the Fed really is in big trouble at the moment, and then finally explain how that impacts AMC and how AMC will squeeze as a result. So stay tuned and let's make some money. Just to quickly remind you, we're currently holding a Valentine's sale over at the Millionaire Mindset Trading Group. Using code Valentine's at checkout gives you $100 off the price of the lifetime membership, or 4 weeks for the price of 3 on the monthly memberships. Also remember the 100% guaranteed refund policy if the educational videos and trade ideas don't help you make a single profitable trade in 30 days. But now let's dive straight in with the key information. So, you may have seen in the pre-market this morning, the CPI data was released. CPI came in at 3.1% versus 2.9% expected. Now, the interesting part of this is that CPI did come down from 3.4% to 3.1% month over month, but the market still reacted horribly. Because inflation hasn't yet come down below 3% into that target 2% area, the market had an absolute meltdown. So the market had a pretty big one-day drop. Obviously, that may not look like much just yet, but if we get that same kind of continuation on Wednesday, on Thursday, and on Friday, that's pretty much 3 months worth of gains wiped out in just 4 days. At that point, we may even start seeing market-wide circuit breaker halts as the market starts imploding. Because remember, the downside to a trade comes 10 times faster than the upside. As soon as we start seeing some big downward movements, all of a sudden you're going to see hedge funds rearranging their positions and cutting tons and tons of longs. There's also a really interesting way this impacts short positions, but I'll touch on that a little bit later when I compare the current market to VW back in 2008. But so Amy has also added this article with the only headline you need for 2024. So the article says that prices rose more than expected in January, as inflation just won't go away. And this is why I want to explain why the Fed and why Jerome Powell is really stuck between a rock and a hard place. Obviously, right now, inflation is remaining higher for longer, and therefore interest rates won't be cut in March, and they likely won't be cut in May either. And as Unusual Whales has tweeted, the big short investor Steve Eisman has said that Jerome Powell is vague on rate cuts because he's petrified of repeating the mistake of Paul Volcker. So if you don't know, Paul Volcker used to be in Jerome Powell's position quite some time ago. He previously cut interest rates too early, causing a second spur of inflation and a massive stock market crash. So Jerome Powell doesn't want to cut interest rates too early if inflation is not done for completely. So therefore, Jerome Powell is going to leave rates higher for longer. But you also have to remember the impact that has on banks. If rates do remain higher for longer, we will see more banks collapsing. So Jerome Powell is literally stuck between a second wave of inflation and stock market crash, and more banks collapsing and a stock market crash. Jerome Powell is literally between a market crash and a market crash, or between a rock and a hard place. And that's ultimately why we saw such a bad reaction today to inflation remaining higher, likely for longer. And as MF Haas has tweeted, they've said bank credit has collapsed. The last time we observed this type of contraction, the great financial crisis occurred. So what we're seeing here is bank credit from all banks changing from a year ago massively to the downside. That basically means that banks are slowing down their lending. That's because banks are taking on heavy losses and they don't have as much cash to lend out, putting us in GFC crisis mode. Or, if you wanted a different word for it, putting us close to a credit crunch. So as I said, we're right in between more banks collapsing, a credit crunch and a financial crisis, and a second wave of inflation and also a financial crisis. We also had 2 brilliant trades today in the Millionaire Mindset Trading Group, starting the day with ARBB or ARB, which ran 172% in the morning, where Firefly locked in 140% gains. We also had OMH, which ran 94% as well. You can see I alerted OMH in the pre-market when it was literally breaking out from that $3.78 resistance just here, where OMH continued to run all the way to $7.37. And he managed to capitalize, making $500 on OMH today. The medic also capitalized, making 32% gains. So as I said, guys, be sure to use code Valentine's, all in capitals, at the checkout, using the link in the description below to join the Millionaire Mindset Trading Group. But so how exactly does that impact the wider market? How exactly does it impact stocks like AMC or Volkswagen from 2008? And what is going to happen to short positions? Well, you'll know in previous videos, I've spoke about those short sellers and hedge funds that have been shorting stocks like NVDA, Meta, Microsoft, Google, and many others all year so far and through most of 2023. Those short sellers lost billions of dollars shorting NVIDIA, billions of dollars shorting Meta, billions of dollars shorting Microsoft, Coinbase, Carvana, and many other companies. These short sellers were shorting here, they were shorting here, they were shorting here, they were shorting here, and they were shorting here. But as these short sellers became further and further underwater, they had to unwind short positions on those big tech stocks. You'll remember I said these short sellers first unwind short positions on big tech stocks. Then they unwind short positions on those heavily shorted small cap stocks like Coinbase, Affirm, Carvana, Upstart, and many others, until finally unwinding short positions on the biggest, the baddest, the meme stocks. Now, from looking at stocks like NVIDIA, it's clear to see that shorts did unwind their short positions on NVIDIA, likely starting on the 8th of January. That's why since then, NVIDIA has nearly doubled already in just 4 or 5 weeks. Again, we can also see that in other stocks like Coinbase that again, pretty much since November has been absolutely rocketing. It did have a bit of a pullback over the last couple of weeks when Bitcoin slumped, but now that Bitcoin is breaking 50k, I imagine Coinbase to continue running. So the short sellers unwinded their short positions on NVIDIA, the large cap tech stocks, on Coinbase, the heavily shorted small caps, but obviously they did not unwind shorts on the biggest, the baddest, the meme stocks. But so what they've done now that they've actually unwinded short positions on big cap tech stocks like NVIDIA and on the S&P 500 as a whole, is they've likely gone long instead over the last week or two. So they've pretty much been shorting the run up and now they're going long just as the market is potentially turning and potentially crashing, causing even more losses to these short sellers. And that's why, as Crystal Paul's tweeted, he said, in my opinion, we're getting close to the market starting to die. That's what Volkswagen needed in 2008. So these short sellers got burnt on the way up and now they're turning long and they're going to get burnt on the way down, causing chaos. And as a result, it seems smart money is coming back on AMC stock. As the French AMC ape tweeted, he said one of the best performing hedge funds of all time, using math and algorithms, Renaissance Technologies, just increased their AMC position by 14,000%. You can see Renaissance Technologies just bought 4.8 million shares of AMC from their February 2024 filing, increasing their AMC position by 14,000%. And as Simulation Ape Nation tweeted, he said, why do they only bash retail investors for holding AMC when many institutions out there have average purchase prices in the hundreds of dollars, but they never mention these hedge funds? Again, that can be absolutely proved as well. If we look at the 13F filings for UBS, for example, who owns quite a few shares, they've got an average purchase price of $200 per AMC share. Again, State Street, almost holding 1 million shares, bought those shares for an average price of $198 per share, and they're still holding those AMC shares. Again, looking at a different hedge fund out there, let's take AllianceBernstein, holding 26,000 shares with an average price of $128. So many of these institutions and hedge funds bought AMC and they're still holding AMC even though they're down significantly, likely as a market hedge. Because when the market collapses, you do have stocks that are outliers out there, like Volkswagen back in 2008, that do squeeze. And that's potentially why Renaissance Technologies has used their algorithms, which are now telling them to buy 4.8 million shares of AMC. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.